Avoid the painful mistakes I and thousands of others learned too late. Everyone talks about the wins in investing, the right coin, the right stock, the lucky break. But behind every big return is a long list of regrets most people never mention. Mistakes that cost thousands, years of progress lost, and in the worst part, they were avoidable. Whether you are new to investing or already deep in the game, this video is your reality check. Because it's not just about what you invest in, it's how you think, feel, and act when the pressure hits. Here are 5 lessons smart investors often learn the hard way. From timing myths to tax traps. Learn them now and save yourself the pain later. Let's start with the first. 1. Timing does not equal skill. Everyone loves to believe they can time the market. Buy low, sell high. Sounds easy, right? But here's the reality. Timing isn't a skill, it's mostly luck. Even seasoned investors get it wrong. They jump in too late during a bull run or panic sell at the bottom of a crash. Why? Because markets move on news, emotion, and global events no one can predict. Not even the pros. The biggest trap is mistaking a lucky trade for actual talent. You buy a coin, it doubles in a week, and suddenly you think you've cracked the code. But if that win makes you overconfident, you'll eventually bet big on the wrong move and wipe out your gains. The smartest investors don't obsess over timing. They focus on time in the market, not timing the market. That means consistent contribution, long-term thinking, and patience when others are panicking. If you feel the urge to wait for the dip or sell at the top, just know most people who try that end up missing both. Second, emotions kill return on investment, ROI. Fear and greed. They're the 2 emotions that quietly wreck portfolios. You feel the rush when an asset's pumping. The charts are green, influencers are hyping, and FOMO kicks in, so you buy. Not because it's smart, but because it feels like you're missing out. Then the price tanks and panic sets in. Now you're scrambling to sell before it gets worse. That cycle, it kills your return on investment. In reality, most bad trades aren't due to bad research. They're emotional. Buying too late, selling too early, overtrading, doubting your strategy the second things turns red. Great investors know how to manage emotions. They set rules in advance, they use stop losses, take profits, and follow a system, not vibes. Some even automate their investments so they don't have to feel anything at all. It's not that emotion makes you weak, it makes you human. But if you want real returns, you have to recognize when your gut is driving your decisions and pause. Because no matter how good your picks are, if you let fear or hype steer the wheel, your gains will eventually disappear. 3. Research never stops. You did your research, read the white paper, watch 3 YouTube breakdowns, scan Reddit and X. You're in. But the fact is, real investors never stop researching because the market doesn't stop changing. A project you believe in 6 months ago could be facing regulatory pressure today. A coin with solid fundamentals might now have abandoned devs, declining users, or major exploits. New competitors emerge, narratives shift. What was once promising can quickly become outdated. That's why treating investing like a set it and forget it game is risky, especially in fast-moving spaces like crypto or tech stocks. You don't have to watch charts 24/7, but you do need to stay informed. That means tracking news updates, team activity, tech upgrades, and market sentiment. Not to react impulsively, but to stay grounded in reality. Research isn't a one-time checklist. It's an ongoing process. The best investors are learners first. They adapt, update their theses, and know when to pivot. Because if you're not actively paying attention, you're not investing. You're just hoping. 4. Risk is personal. There's no one-size-fits-all strategy in investing because risk means something different to everyone. Some people are fine riding out 50% drops. Others lose sleep over a 5% dip. And that's okay. What matters isn't what the internet says you should tolerate, it's what you can actually handle without making bad decisions. If your risk tolerance doesn't match your portfolio, you're setting yourself up for emotional exits and regretful trades. Maybe that high growth altcoin sounds exciting, but if one red candle makes you panic, you're better off with something more stable. And beyond feelings, your life situation matters. Got kids? Bills? No emergency funds? Then going all in on volatile assets might be reckless, not bold. On the other hand, if you're young, debt-free, and have a steady income, you might afford to take bigger swings. Smart investing isn't just about chasing high returns. It's about aligning your portfolio with your personality, responsibilities, and goals. So ignore the bravado online. You're not weak for playing it safe. You're smart for knowing what you can handle. 5. Taxes matter more than you think. It's not what you make, it's what you keep. And nothing eats into profits like taxes. Most new investors completely overlook this. You sell at a gain and celebrate. But come tax season, surprise, you owe a chunk of that win to the government. In some countries, short-term capital gains are taxed as regular income, which can mean giving up 20%, 30%, even 40% of your profit. Then there's crypto. Many people think they're flying under the radar, but more and more countries are cracking down. Every buy, sell, swap, or even NFT flip could be taxable. The smart move? Plan ahead. Learn the difference between short-term and long-term capital gains. Consider holding investments for over a year to reduce your rate. Use tax-advantaged accounts where possible. Track every trade manually or with tools like Coinly or CoinTracker, because a 40% tax bill can turn a good trade into a bad one real fast. Don't wait for April to figure it out. If you care about your return of investment, you have to care about taxes. It's not boring. It's what separates amateurs from pros. This is how it starts, one smart move at a time. Investment isn't just about picking the right asset. It's about managing your mindset, your risk, and the reality of the game. Skip the ego, avoid the hype, and don't wait until you've made the mistakes to learn the lessons. Stay calm, stay informed, and stay focused on the long game. Because real success doesn't come from chasing the perfect moment. It comes from stacking smart moves, one after another. Hit the next video and keep building the life you deserve. Take care, my friend.